أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So our topic is financial analysis, the big picture. Now we're getting into the actual higher level work of business consulting and so forth, which you will be more likely to be involved than recording debits and credits. The debits and credits we did in our previous classes so that you know where the numbers come from. It's not a mystery when you look at an income statement. For example, we have an income statement in front of you, right? And you have prepared several of them, so you know how these numbers come, right? So now we're going to start learning what we do with these numbers. What do these numbers tell us and how we act based on these numbers. Okay, so this I already told you. The thing that we have to do in addition to what we just discussed is form groups. Okay, so we have a group project that we're going to do, and I'm sure you have formed groups in other classes as well, yeah? So 2 or 3 people in a group, okay? And please make sure you select the group members today and you form the groups, and then in the next class I'll talk more about the details of the assignment and so forth, inshallah. Okay? Today's class is crucial because this is going to start building your base on how to analyze financial statements. Okay, so let's start with the first topic that we're going to discuss, which is sustainable income. What is sustainable income? Sustainable income is the income that you normally have from a business during the regular course of operations that don't take into consideration anything special, anything that is sit where there is a set of notes, sit where there is a set of papers, anywhere there's a set of papers. Now, if you're working and you're getting a salary, right, and all on a sudden in 1 month your company does very well and your boss gives you a 5,000 real bonus, right? This is something that you would not consider as a part of your income looking into the future. You are not going to consider that you have this extra 5,000 because this is just an unusual item, right? You don't know whenever it will come again, or will it ever happen again or not, you don't know, right? So those are unusual or extraordinary, irregular income. Sustainable income is that income that is your normal level of income, okay? And irregular items are put into 2 different categories. One is discontinued operations, and the other one is extraordinary item. And we're going to talk about both. What is discontinued operations and what is extraordinary items? These 2 are called irregular items. They are not your regular income in the business. Miss Ala, sit where there is a set of notes. Okay. The normal level of your income, right? The normal level of your income, right? So, for example, you have a weekly sales of 10,000 riyals. So you sell 10,000 riyals every week. That's your normal level. Because of Eid, you may have had an additional 5,000 riyals income. Well, this will disappear the next week when everything is open again. People go back to work, right? Next year again, maybe you will have, maybe you won't, right? You don't know. So this is not regular income. This is irregular income. The irregular income are put into 2 categories: discontinued operations and extraordinary items. We're going to discuss both, what they mean. If you look at a financial statement, you have prepared an income statement that has sales, goods sold, gross profit, and operating expenses, and then you stopped here, which says income, right? This number that you prepared, it's in your financial statements, you called it net income, right? This is where you stop. You prepared until this point. This is in a more comprehensive income statement. This number is called income from operations. So this is all items that are related to operations, regular business. Then you have a line that says other revenues, expenses, and gains or losses, right? There is other revenue and gains or expenses or losses that come from outside your operations. For example, if you had two buildings and you sold one of them, your business is not building buildings and selling buildings. You had a building, or you had two bulldozers, right? You sold one of them, and because of that you had some gain. This would be in this category. This would be other income, other revenue, right? This is from your operations. You're not in the business of selling buildings or bulldozers. You have them to do business. When you sell, money comes, right? This is not from your regular operations. Are you following, right? Then you have income before income taxes. By the way, what I just told, this is not extraordinary or continued operations, right? This is happening in the normal course of business. It can happen again sometime soon, right? You can buy and sell cars that you drive for your business. This is not extraordinary item. Follow. But this is also not from your operations. Your operations, let's say, is to make hamburgers and sell hamburgers. You had two delivery trucks, you sold one of them, and because of that you got some money or got some gain, right? This would be in this other category. Are you following? Then the line is income before income taxes. So the income that is used to calculate the income tax is the next line. Then the income tax is calculated, right? And the income tax is the income tax expense is shown in another line after the income before income taxes. So this is where the normal business ends. You have income tax expense, and this is the end. Then comes income before irregular items. So this is where we have the irregular items starting after this income. This is from all the regular income items after the income taxes. The irregular items, which are discontinued operations as well as extraordinary items, they are shown net of tax. What does that mean? Let's say you had $100,000 in income before irregular items. From the discontinued operations, you had a $50,000 income, and the tax on that income was $10,000. This line will show 40,000, 50,000 income minus 10,000 tax. So net of tax means, because we already calculated the tax in the other income, any income that comes after this will be put in net of tax. The tax of that item will be calculated separately, and it will be shown without tax. Yes. I'm going to show you this with an example which has numbers. Okay, so it will come to you. I'm going to show you an example exactly what it means. The same happens to extraordinary items, right? The extraordinary item, whatever that item was, whatever the income was, minus the tax on that income is shown on this line. So before we calculated all the income and we calculated the tax for all of that income and we subtracted the tax. Anything that comes after that will be net of tax. So if this $50,000 discontinued operations and 10,000 tax on that, we will put 40,000 on this line, 50 minus 10. Again, I'm going to show you specific examples with numbers, right? This is the basic format of the income statement. Then those two items subtracted from here, we have the net income. This is the actual net income, which includes all these items. Then there is another line which is called other comprehensive income items net of tax. And what is other comprehensive income I'm going to explain to you in just a few minutes, inshallah. There is something called an other comprehensive income. That other comprehensive income do not go to the income statement. It goes directly to the stockholders' equity. Okay, so in other words, the comprehensive income does not go through the income statement. It directly hits your retained earnings. Okay, and again, this I'm just telling you this the first time. I'm going to show you examples, details of what this thing is. Okay? There is something called other comprehensive income, and then that is subtracted from the net income, and you calculate the comprehensive income. So this is the basic format, right? We are going to come back to this format again with numbers. And in the middle, we're going to learn each one of these new items. Are you following? Okay, so let's start with the first one. You are okay with all the items until the income tax, because we have the income tax expense and income before irregular items. Everybody's good with that number until that. This is, we have discussed most of this before. The only thing that is added to this line is this other revenue, which is not from operations, which is not from operations. And it could be anything. It could be anything. For example, in the US, during this COVID-19 period, the government gave small businesses and individuals money because of the loss of their income. So let's say you had a restaurant, normally you have $40,000 in sales, but due to COVID-19, you suffered. The government gave you a check, let's say, of $10,000, right? Where would this go? Other, because this is not from your operations. Operations is you're selling what you normally sell, and you're spending money on what you normally spend money on. You follow, right? You buy material and you make sandwiches. Anything that is related to that is operations. Anything outside that is other. You follow? Now, what do we mean by discontinued operations? Let's start with that first. Discontinued operation is the disposal of a significant component of a business, which means, let's say you are in the business of making computers, phones, televisions. You stop making televisions. That means that is a discontinued operations. Stay with me, listen to me very carefully. 2020, this is 2020. Until 2019, you made computers, phones, and televisions. In the middle of 2020, let's say June of 2020, you said we are no longer going to make televisions. But you made televisions until June, did you not? Right? That means you have some profit or loss from making and selling televisions until that period, right? That has to be reported on the income statement somewhere. Are you following? Right? If you did not stop that operation, if you continued making television, it would show up as operating expense. But because you discontinued that operation, the income and expenses only from the television section is going to show up in the it's going to show up in the discontinued operation. So this is what exactly discontinued operation means. So income statement should report any gain or loss from discontinued operations net of tax. So you calculate the income and expenses from the TV making and selling separately, and you calculate the tax on that separately, okay? And then you show that on one line so that you know that this is no longer going to be in the income statement in 2021, because in 2021 you are not going to make a single TV. Is that clear? So let's take a look at how this goes into the financial statement. Rosec Incorporated has revenue of 2.5 million and expenses of 1.7 million. From the continued operation in 2014. So you see here, income before income taxes, this is from operations, and income tax on that income. So now we have income before irregular items, okay, shown in one line. Then we have the discontinued operation. What does it say? The company therefore had income before income taxes 800,000 during 2014. The discontinued and sold, the company discontinued and sold its unprofitable chemical division at a loss of 210,000 net of 90,000 tax savings, right? So this 210,000 number that is coming from the discontinued operation already includes the tax they paid. That means before tax, it was 300,000, 210 plus 90. Are you following? So when this number shows net of 90,000 income tax, it's 210,000 net. So they had a loss from the discontinued operation during that year. They had a loss of 210,000 net of tax. Are you following? Net of tax. If you have a gain, if you have income, you will have positive tax. If you have a loss, right, it saves you tax elsewhere. So that's why it says net 90,000 tax savings, right? It's a bit difficult to understand at first. Follow what I'm saying here. Let's say, as an individual, I have a $10,000 income. All right, I have a $10,000 income, and I have to pay $1,000 in taxes, 10% tax. Are you following? I have $10,000 income, the tax is 10%, so my tax is going to be 1,000. Clear? Very simple. Let's say I have $1,000 loss, right? $1,000 loss from a discontinued operation. Now, my total income, including that loss, would be how much? Before I had 10,000, now I have $1,000 loss. What would be my total income if I combine those? 9,000. What is my tax on 9,000? 9,000. My tax on 9,000 is how much? 10% tax. 10% of 9,000 is how much? Come on. It's what? Tell me. Don't be shy. Make a mistake, no problem. It's not 9%. It's 10%. But how much? 900. Yes. 900. Very good. Now, before I had the loss, what was my tax? Because of the loss, what is my tax? That means I saved $100 in taxes. This is what it means. Because of that loss, there was a $90,000 tax savings. You follow? If it is positive, right? If it is positive, so let's do the other example. Let's say I have $10,000 normal income, $1,000 income tax. I have another $1,000 gain from the discontinued operations, right? If I have $1,000 gain from the discontinued operation, how much tax do I have to pay on that 1,000? How much? 100, right? You follow? 100. That means the line of the discontinued operation will show how much? 900. Because I have to pay an extra $100 tax. So if you have gain, right, there is extra tax. If you have loss, you save tax. You follow? They saved 90,000 tax, right? That's right. Not only will they not pay, but it reduces their other income.
Okay? It reduces their other income. So if you have loss, it reduces income from other places for the income tax calculation. Okay? Again, this is the first time. I can understand, I can appreciate the difficulty. Don't worry about it. We'll do more examples. It will come to you, inshallah. It will come to you.
Okay, so that's discontinued operations. Now, the next item is extraordinary item. Extraordinary item has two conditions. The first one is it is unusual in nature. It is infrequent in occurrence. Unusual in nature and infrequent in occurrence, meaning this is not normal. It does not happen, right? And infrequent in nature means it doesn't happen often. So for example, COVID-19 is a perfect example, right? COVID-19 is a perfect example. It's unusual in nature and is, inshallah, infrequent in occurrence, okay? Because if it frequently happens, then it's no longer unusual, right? Okay, this is also done net of tax. Now this slide does not show up properly here, so I'm going to show you the slide in the regular screen instead of Blackboard. Okay, let's see where last slides. Okay, now let's take a look at this. It says in 2014, a revolutionary foreign government expropriated property held in investment by Rosec Incorporated. If the loss is 70,000 before applicable taxes, then how will the loss be presented? So the government took something from them, and for a foreign government took something from them, and because of that, they suffered a loss, right? So again, this is extraordinary item. This does not happen regularly. This does not happen on a regular basis. Therefore, this is considered an extraordinary item. This is also showing net of tax savings. Okay, this is also showing net of tax savings, right? As you can guess, most extraordinary items are not going to get you a gain. Most extraordinary items do not get a gain. Are you following? Right? Okay. Let's look at some more examples. Don't look at the answers. Don't go to the slide. Stay on this slide. Don't move. Let me see if we can answer this. The first one, we are going to decide whether this is an extraordinary item or not, right? Don't look at the next slides if you have them printed. Effects of major natural casualties if they are rare in the area. So natural casualty like earthquake or flood or things, it is not very common in the area. If it happens, is it extraordinary or not? It is, right? So it's yes. Effects of major casualties, not uncommon. For example, Florida, cyclone happens. I mean, the tornado comes every year, right? The hurricane comes every year. Is it extraordinary? It is not extraordinary. Do you follow what I'm saying, right? How do you decide that? Write down of inventories or write-off of receivables. The price of the inventory reduced because the inventory is outdated, right? Because you had a large inventory of iPhone 9 and iPhone 10 or 11 came out. Because of that, the price has reduced because you cannot sell it for what you used to sell it for because the latest model is out, right? It happens to cars every year. The older models are reduced. Or write-off of receivables. You cannot receive some money from your customers because they're not going to pay. Is this extraordinary item? I'm going to leave. You say discontinued, I will leave. I will not come back if you say this is discontinued operation. The question is not even whether it is discontinued operation or not. The question is it extraordinary or not? Right? What is discontinued operation? You used to have a particular business and you do not have that anymore. Making TV, making phones, no longer making, right? Making a particular type of car, for example, right? No longer have that model. You stopped making that. That factory is closed. That is discontinued operation. Discontinued operation is very narrow. You have a lot of different things that happen with it. You follow what I'm saying? You had a business, you don't have that anymore, that particular segment. Okay, so this is not extraordinary. Expropriation or takeover of property by a foreign government. You should all answer this correctly. Yes, we just had an example, right? Okay, loss attributed to labor strikes. This is a tricky one. Is it extraordinary or not? You would say that it is not, because they are not unusual. They happen. Okay, labor strikes are not unusual, right? If you are in an environment where it never ever happened, right, then it would be. But for most countries this would not be, right? This would not be. Labor strikes are not something that is considered extraordinary. This is part of business. Okay, this is part of business. In Qatar, of course, we would say this is extraordinary because it never happens, right? Okay, effects of a newly enacted law or regulation such as condemnation action. This is a sort of US verbiage here. The answer to this is yes. Let's not go into more explanation of this. Let's leave it aside. Gains or losses from sales of property, plant, and equipment. Where would this go? Gains and losses from the... Tell me. Give me the right answer. Is this operation? Gain of loss from the sale of property, like a building or a factory. This is not from operations. Selling property is not your business. You have a building, you sell it. This is not from your operations. You have a machine that makes ice cream and you sell that. This is not operations, right? What is this? Other gains, yes. Say that again. If it is your business to buy and sell land, then this is normal course of operations. But for most companies, this is not. Okay? You would not list that item as property, plant, and equipment if you buy and sell buildings. If you buy and sell buildings, how would you classify the building? This is a very fine, detailed question. If you are in the business of buying and selling buildings, would you classify the building as a long-term asset? Where would you classify it? Current asset under what? As what? Somebody said inventory. Who said inventory? Inventory. This is what you buy and you sell, right? Did you buy and you sell? Forget about how much it is, right? This is, you're buying it with the intention to sell it. This is just like any other inventory item. Are you following, right? If I am in the business of buying cars and selling cars, I'm not going to list it under property, plant, and equipment and depreciate it. This is my inventory, right? It shows up in inventory. So I buy, and when I sell it, it will show up in cost of goods sold. Are you following, right? So property, when I say property, plant, and equipment, if you classify it as property, plant, and equipment, it is not going to go to operations. It will only go to operations if it is classified as inventory. Does it make sense? Okay. Very good. Now, this is an introduction to the discontinued operation and extraordinary items. So far so good. Everybody follow? Now we have something called changes in accounting principle. And you have not studied these different accounting principles in details yet. That's why this chapter 13 is chapter 13. And we're from 5 to 13 because some information here is supposed to come before this. But the reason why we are going to chapter 13 and doing the financial statement analysis chapter first, so that you can have more time to work on your project. You follow? If I do this in the 10th week and I give you 2 weeks to present, you don't have enough time. So I'm going to explain you what this means when we say changes in accounting principle. There are certain accounting principles that you have the option to choose from in accounting for certain parts of your financial statement. For example, you can use a particular inventory accounting system which is called FIFO. FIFO. FIFO means first in, first out, right? First in, first out. There is another one that is called LIFO, which means last in, first out. How is the FIFO and the LIFO calculated and what is the advantage and disadvantage? We will learn that, right? But let's say a company chooses FIFO, method of doing accounting using FIFO, does accounting for a couple of years using FIFO, and then it decides to choose to switch to LIFO, right? This is what we call change in accounting principles. So if this happens, right, it is permissible, it is allowed, right? It is allowed to change, but you have to prove that the new system is better for your business, right? You cannot just do, because calculating using FIFO creates a different amount of income than calculating using LIFO. It changes the number of, it changes the income amount. It switches your profit and loss. Are you following? How exactly does it do that? You will learn. But changing accounting principles switches. So let's say I have a year, a particular year, when if I use FIFO, my company will show more because of the calculation. And then in the next year, if I use LIFO, my company will show more profit, and then I keep switching between LIFO and FIFO depending on which is better for me. This is not allowed. This is not allowed, right? This is unethical practice. But if you make one-time switch, you used FIFO for a couple of years and you say, no, FIFO is not the best. We're going to switch to LIFO and we are going to continue using LIFO. If you do that, then these changes have to be reported retroactively, meaning if you switch the accounting principle, you have to recalculate your profit and loss that you reported before, and you would have to say, with the new system, my profit and loss in the previous would have been X. You follow? Exactly how that happens, we're going to learn. Just know the gist of this is changing of accounting principle is allowed, but you cannot go back and forth every year. If you do change, then all the reporting must be retroactive, meaning you have to go back and you have to recalculate and report. How exactly? We will learn, inshallah. Whatever you have, this you don't have to republish your financial statements. It is reported in the current financial statement somewhere, and where exactly we're going to learn. Okay, this is shown so that it is known to the user that because of this change, right, let's say you reported retained earnings 1 million from the past 2 years, right, and because of this change, your retained earnings, the income from the last 2 years would have been 200,000 less. So you would adjust the retained earnings and you would say that the retained earnings is 200,000 less now. You don't have to go to the previous years, but you will change the retained earnings. The retained earnings is all the income until now from the beginning, right? Retained earning. Retained earning, you add the income and you subtract the dividend. Every year, add the income, subtract the dividend. So the number in the retained earning shows all the income that you had from the beginning until now. You follow? So when such a change happens, it's usually in the stockholders' equity directly. Again, just something I'm throwing at you. We will see exactly how it happens, okay? All right. So this brings us to comprehensive income. Comprehensive income is all changes to the stockholders' equity except two things. That is, investments made by the stockholders and distribution to the stockholders. In other words, debit to cash and credit to common stock, and debit to dividends and credit to cash. These two are not comprehensive income items. They are regular course of business, okay? Comprehensive income are certain gains and losses that are directly adjusted in the retained earnings without going through the income statement. Certain gains and losses are not reported in the income statement. So we came down gradually. First we had the income from operations, then we have income from discontinued operations, then we had income from extraordinary item. End of story with income statement. There could be certain other items from where you might gain or lose. They are not reported on the income statement. They're reported as something called a comprehensive income. Are you following? Yesterday, after Salatul Dhuhr, somebody stopped me outside the masjid and he said, what is there in accounting other than debit and credit? What exactly do you teach? You know, what is there? I don't have to tell you what is there. You follow what I'm saying? I said debit and credits, the accountants don't even do. Bookkeepers do that. You follow? So the debits and credits part is over. Now the real stuff starts. What is comprehensive income? An example is unrealized gain or loss on available for sale securities. What is security? Security is stocks and bonds that a company buys of another company. Okay, so let's say you have a company, the company's name is Doha Investments. Doha Investments goes and buys stocks of Apple and Microsoft and Dell and Vodafone and so forth. When the company buys stocks of other companies, it is not its own stocks. Its own stocks we already accounted for. It goes to the stockholders' equity. There is no income or loss with the stock or dividends. All right? If the company buys stocks of other companies, right, it can buy it with intention of selling, In that case, those stocks are called trading stocks. It will come. They're called trading stocks. Trading, it's in your slides, T-R-A-D-I-N-G. So you buy and you're going to sell. You're buying and selling. That's what your goal is. You're buying and selling the stocks. That's what your intention is. Those stocks are called trading stocks. Available for sale securities are those that you bought. You really don't want to sell, but you will if you find a very big gain or very big price. This is available for sale. You follow? Are you following? So you buy a car, your intention is not to sell it, you're driving it, right? But somebody says you bought it for 100,000 riyals. Somebody says, I'll give you 200,000 riyals for this. Please sell it to me. I love this car. I want this car. 200,000? Faddal. Take the car, right? Give me 200, I'll buy two of them. You follow what I'm saying, right? This is called available for sale. Your intention is not holding it to sell. If you hold it to sell, they're called what type? Tell me, I just told you. Trading. Buy securities and your intention is to sell. You're trying to sell them. This is called trading. Okay, let's take a look at an example. It says, during 2014, this company purchased IBM stock for 10,000. So you see this company, Stasi company, buying IBM stock. So it's not its own stock. And they paid 10,000, okay? They paid 10,000. At the end of 2014, because of the stock market fluctuation, the price went down to 8,000. So when they purchased it for 10,000 and it went down to 8,000. The question is, this type of loss is called unrealized loss. Unrealized loss. Unrealized loss is, there is a loss, but you will only experience the loss if you sell. Okay? You're only going to experience the loss if you sell. Most people here have purchased gold, I'm sure. Gold. Foreign language, you understand gold, yeah? You purchase gold, right? Anybody here purchase gold, right? Gold price, as you know, goes up and down, right? You purchase something and the gold price was 200 riyals per gram. Price goes down to 180. You really don't have a loss if you don't sell. You follow? You're waiting, it will be 220. You also have a gain, but you really don't have a gain until you sell. So this type of fluctuation in price when you have the item but you did not sell, it's called unrealized loss or unrealized gain. It will be realized, it will be real. The loss will be real if you sell. The gain will be real if you sell. Until then, this is called unrealized loss. Are you following? So what happened to this company? The company paid $10,000 to purchase the stock. Price down to 8,000. So they have a $2,000. What do we call it? Unrealized loss. Here, what is unrealized loss? What should the company do? It depends on what type of security it is. What is their niyyah with this security? What did they intend to do? If it was trading, right? If it was trading, which means when they purchased the stock, what was their intention? What was the niyyah? To sell. Very good, excellent. In that case, this will go to income statement. Okay? This will go to income statement. You would have to record the unrealized loss on the income statement. But if it was available for sale, which means did not want to really sell, but they would have sold if the price was high, this will go to other comprehensive income. Is that clear? Is that clear? Okay, this is an example. So how is other comprehensive income? So let's say it goes to other comprehensive income. The other comprehensive income is reported in two different ways. The other comprehensive income is reported in two different ways. I think I should go back to Blackboard. The first way is this. You have the net income. You remember the net income number. This is after discontinued operations, right? After extraordinary items, the net income. You have the net income coming to the statement of combined statement of income and comprehensive income. So after the income statement, there is another statement which is called the combined statement of income and comprehensive income. The first line there you see is what? Net income, and then the 2,000 unrealized loss showing the comprehensive income as 290,000. This is one way of reporting it, preparing preparing a separate statement which is called combined statement of income and comprehensive income. The next option is go to the balance sheet directly, which is, this is the stockholders' equity, right? You just hit the stockholders' equity with this unrealized loss of 2,000 and you adjust the stockholders' equity. So whatever the retained earning was, it will be reduced by 2,000 and your stockholders' equity is going to be calculated. All right? You get the general idea. Are you following? Any questions? Yeah. So the comprehensive income item, anything that is not going to go through the income statement, you can prepare a statement of a combined statement of income and comprehensive income, and then you can take that number from there and you can go to the stockholders' equity. It will not go to your regular income statement. Or you can just directly go to the stockholders' equity and adjust it for $2,000. It says, you see, this is the balance sheet, right? Directly, the stockholders' equity section. Remember the balance sheet you prepared. It has 3 sections: assets, liabilities, and stockholders' equity. You prepared several of them. The stockholders' equity has the common stock and retained earnings. You remember those 2 numbers, right? You subtract the gain, subtract the loss from that number, or if there is a gain, you add the gain to that number. Is that clear? It goes directly to the balance sheet. It does not go to the income statement. Clear?
So the first one, you are assuming the company stock is trading security.
No. Trading goes to income statement, right, which we did not do. We are just, the 2 that you see, they are both adjusted to comprehensive income. So we are saying that this is available for sale security. If it goes to income statement, it will come before net income. Okay, so this is, both of these situations are 2 options of doing comprehensive income, not income statement. We're not going to the income statement. Is that clear? Okay, now, so we have this complete financial statement now, this, all of these items here with the numbers and so forth, right? So we have income from operations, other gains and losses, discontinued operation, extraordinary item, and then you have the net income. Then this is the combined statement. You see, this is this part, this section right here, unrealized gain on available for sale securities. This will come after the net income to add to the comprehensive income or loss. This portion will not be showing up on your income statement income. The net income is going to be before that. You follow? The net income is not going to include, because there is no tax on this item. There is no tax on this item because you did not sell. You follow? Unrealized gain or unrealized loss, right, does not have any tax consequence. If you buy a piece of gold and it's 1,000 riyals, next year the price goes up and it's 2,000, the government says, give me tax. He said, I don't have money to give you tax because I did not sell, right? I'm not going to cut a piece of this gold and give it to you. You follow, right? Maybe the price will go down next year. So this is unrealized. There is no tax. Therefore, it does not go to the income. It is after the net income, yes. It is not calculated. The net income calculation does not include this. You follow? Okay. Yes, yes.
Where does the net income number come from here in this sheet?
Here,
Yeah.
the net income. So you have income before irregular items, right? Plus the discontinued operation minus the extraordinary item equals this number. Clear?
Before irregular items, plus this counted for minus extraordinary.
Plus the discontinued operations, you had gain, minus extraordinary, where there is loss. coming to the net income. Clear? Okay, very good. Yes. Say that one more time.
Right. So this extraordinary item from tornado, the loss from tornado, this could be, right, destruction of your property where you have to pay and build. You follow what I'm saying, right? So this is the extraordinary loss. Because of that, it has some hard to do business and it had to cost you some money to fix certain things. So that's the extraordinary loss.
Even if we didn't fix it, right? We consider that.
No, this is, you cannot consider expense, right, unless you have a real loss, right? If you have a real loss, so for example, let's say you have a building that you had on your books, and the building is demolished, right? So now the value is zero, so you have a real loss. You follow, right? So that is an extraordinary loss. Loss of sale would not be here. You follow? Because it cannot be calculated. Are you following?
Okay. Now we have the analysis of financial statements. We have something called intra-company, that is between two different companies. Intra-company is not between two. Intra-company is within the same company, in the same company. Intercompany is between two different companies. And then you have a comparison of your company with the industry average. And we're going to look at several of these. You have three different types of analysis: horizontal analysis, vertical analysis, and ratio analysis. And we're going to start discussing each one at a time, inshallah. Let's do the first one, which is horizontal analysis. Horizontal analysis is the trend analysis. You want to see this year compared to the previous years. Is your sales going up? Are your expenses going up, or are they going down? Right? You want to see in your company where things are going. Okay? This is called horizontal analysis, from one year to the next year. So let's take a look at an example. You have here, you see 2011 and 2010, right? So the current assets reduced from 2011 to 2010, and the change is 11.9%. You follow? 11.9%. So for each one of these items, you see there is a calculation of change and a calculation of what percentage it changed from one year to the next. This is called a horizontal analysis. We do that for both the balance sheet as well as the income statement. These are the two items, two statements. So here, as you see, the sales in 2011 was 11,776. In 2010, it went down. There was an 8% reduction in sales. Is that good or bad? It's not good, right? It's not good at all. So here again, you have, these are in thousands. So here you have 1,103,000 net income in 2011 and 1,004,000. So this is, all of these numbers have three zeros after that, they're removed. Anyhow, if you compare these two numbers, the sales actually, the net income actually reduced 99,000. Is that good or bad? Yes.
Why are we comparing now? Like,
Why are we comparing what?
for example, you're comparing how the net income from 2011 and the net income from 2010. So we see a decline, so it went down.
Oh, I'm sorry, I'm doing it the other way. I'm doing it the other way. Thank you so much. I'm doing it the other way. It's actually good because this is the latest. Thank you so much. I was taking 2010 and 11 and 11 as 10. Thank you so much. So actually this is good because in 2011 it is. How come nobody else caught this? Excellent, very good. It's actually good because in 2011 is a later year, right? So it goes up, it's good, very good, excellent. So we want to see upward trend is good, right? So this is called horizontal analysis. Vertical analysis is when you look at the income statement and the balance sheet from up to down. So you look at all the numbers, right, as a percentage of the total numbers in the balance sheet, and you look at all the numbers as a percentage of sales in the income statement. That much is not correct. We can go for 4 or 5 minutes more, okay? Inshallah. So let's take a look at what a vertical analysis is. You see, the 100% number is the total number for assets, 100% number is the total number for equity. So you see what percentage of the total assets is current assets, what percentage of the total assets is current asset in the previous year. You follow? So you want to see from top to bottom what percentage of your individual item in the balance sheet is compared to the total number. Are you following? How much is the current liabilities compared to the total liabilities and stockholders' equity? How much is the long-term liability compared to the total liability and stockholders' equity? This is in the balance sheet. In the income statement, the 100% number is the sales. So all numbers are calculated based on sales. So for example, your net income is 9.4% of sales. Your income is 9.4% of sales, right? And here in 2010, your income was 9.1% of sales. Obviously, 2011 is better, yeah? 2011 is better. Now, if you're in a particular industry, all of these percentages, for example, the gross profit or the cost of goods sold, all of these percentages, they have an industry average. So for example, I used to work in the US, we used to look at the small business restaurants income statements, and for a single store Quiznos or a single store Domino's, the cost of goods sold is 30%, right? The cost of goods sold is 30%. This is a number that you know if you are an industry expert. You follow. You cannot know this number for all industries, right? So if somebody says, what is the cost of goods sold number for a car manufacturer? I have no clue. I don't have any idea. Follow. But I could tell you the numbers, the industry average numbers for every single one of these items for a small business restaurant in the US. Again, these vary from location to location. So the cost of goods sold is, for example, 30%. The labor cost is, for example, 25%. The advertising is 10%. The location is 10%. The rent is 7%. So these numbers, you not only compare them with your previous years or other companies, if you're comparing with other companies, but you also compare them with a industry average, which gives you the target, that if you're somewhere in the neighborhood of that number, that means your operations are under control. They are going as they're supposed to be. They're happening as you know, the numbers are in the industry. You're following the norm. You're not outside the norm. Does that make sense? So these are two different ones. And then there is a third one, which is ratio analysis. And I think we're going to do the ratio analysis, inshallah, after Professor Prescott's presentation. Okay, so we'll stop here now, take a 10-minute break and come back, inshallah. Professor will join us at 7:15 and he'll start speaking at 7:30, inshallah.